Welcome to the Paragon Podcast, a podcast focusing on the needs of high net worth individuals and their families. We discuss the markets, tax strategies, and how to better manage wealth with the goal of living better for today while planning for tomorrow.
Hi everyone, I hope you're all doing well. This is Elean Mendoza, and I'm here with Evan Shorten, the firm's founder and principal.
Hello, we hope you're doing well despite the recent market volatility. I know it can be unnerving, but hopefully you're finding ways to stay sane. I also want to thank everyone who listens to the podcast and subscribed. Lastly, before we begin, I want to ask a favor. If you're listening and not currently subscribed, I would greatly appreciate it as we're trying to grow the podcast. Lastly, if you know anyone that might enjoy the content or the information we provide, it would be great if you could forward it to them.
As you mentioned, it's been a very rough year for investors, with both the S&P 500 and Dow Jones hitting yearly lows twice. The first time was earlier this year in June, and most recently at the end of September, following the most recent Federal Reserve Fund's interest rate hike. Now, no one likes to see the value of their portfolio decline, especially when it's your nest egg. But with that said, down markets do create a few financial opportunities from a financial planning perspective. In this episode, we're going to discuss Roth conversions as a viable financial planning strategy for a down market. And in the next few episodes, we'll discuss a few other strategies as well. Before we get started, I want to remind everyone that this is not financial advice and should not be taken as financial advice. While we may be discussing a specific strategy, it does not mean this strategy applies to you. And if you choose to look into the possibility of whether a Roth conversion is right for you, please consult your financial advisor and CPA first. So with that said, let's start off by doing a quick refresher of what is a Roth conversion.
A Roth conversion is a retirement strategy focused on moving assets from tax-deferred accounts like a traditional IRA or a qualified employer retirement plan such as a 401k into a Roth IRA for the purpose of either maximizing your tax-free income in retirement or to allow your retirement funds to grow without the requirement for minimum distributions or RMDs.
And why would you need to do a Roth conversion? Why can't we just open a Roth IRA from the very beginning?
Typically, high-income earners are not eligible to contribute to Roth IRAs. For a single filer, your ability to contribute to a Roth IRA starts to be phased out at $129,000 in income, and at $144,000 income, a single filer can no longer contribute to a Roth IRA. For married couples filing jointly, the phase-out begins at $204,000 per year, and at $214,000, contributions are no longer allowed. Oftentimes, employer-sponsored retirement accounts or traditional IRAs are the best retirement savings options for high-income earners. However, employer-sponsored retirement accounts and IRAs are most often tax-deferred, meaning you receive a tax deduction on the contributions you make today, but eventually will have to pay taxes on the income when it's distributed to you in retirement. With a Roth IRA account, you don't have to receive a tax deduction on your contributions today, but your future retirement income from the Roth IRA will be tax-free once your Roth IRA has been established for at least 5 years and you've reached the age of 59 and a half.
Okay, and now why is that a more preferable option?
First, if you're not planning on needing or using IRA funds for several decades, there's a good chance you can pay the taxes up front today and grow your retirement assets to provide you a significant tax-free income in retirement. The reason we sometimes view this as a favorable trade-off is because we're coming off the lowest tax rates in history. It's highly likely that income taxes will be higher in the coming decades, as well as many deductions for high net worth individuals may either be eliminated or reduced. Another reason we may want to pay the taxes today is to maximize your estate for your heirs, if that's a goal. Because a Roth requires you to pay taxes up front, the IRS considers the taxes as having been paid on those assets. As such, they don't require minimum distributions once you reach the age of 72. This allows assets in your Roth IRA to grow undisturbed without having to make withdrawals that would normally slow down the compounding effects of long-term savings.
So in general, Roth IRAs are superior retirement savings vehicles than traditional IRAs for the reasons you mentioned. But what are some of the drawbacks of a Roth conversion?
Well, death and taxes. Your lifespan and expected use of the funds will dictate if a Roth conversion makes sense for you. Once you move assets from a traditional IRA or other qualified retirement account to a Roth IRA, the converted dollar amount will be treated as ordinary income tax and could risk pushing you into a higher marginal tax bracket at both the federal and state level. This happens because you already received a tax deduction when you first contributed to your retirement accounts, and now the IRS wants the taxes it never collected. Essentially, for a Roth conversion to be worth it, you have to live long enough to earn back the taxes paid through the growth in assets and/or income generated by the account. Additionally, it can impact how much you will pay for your Medicare for the following 2 years before your taxable income drops back to quote-unquote normal levels.
Okay, so why does a Roth conversion become an attractive financial planning strategy during a down market?
Well, simply put, you can convert a greater portion of the assets to your Roth IRA for the same tax bill when financial markets were higher. Let me give you an example to clarify and provide a bit more detail. Suppose you did a Roth conversion of 100 shares of Apple back in January of this year, when the stock was around $182 per share. The total Roth conversion amount would be $18,200. If we assume you're in the 35% tax bracket, you could be looking at a tax bill of $6,370 for converting 100 shares of Apple from your traditional IRA to your Roth IRA. Today, October 21st, 2022, Apple closed at approximately $147 per share. Today, you can convert about 123 shares of Apple for the same tax bill of $6,370, allowing you to convert an extra 23 shares than earlier this year. If markets stay down for a significant period, well into next year, the Roth conversion becomes increasingly more attractive as you can repeat the process without increasing your tax liability from one year to the next. You could convert an amount that you're comfortable paying taxes on this year in 2022 and again next year in 2023, as opposed to converting one large sum in a single year and substantially increasing your tax liability. Again, any amount you convert will be treated as ordinary income in the current year. As such, one popular approach is to convert up to your tax bracket's limit, meaning you can cap the amount you convert to Roth so that the convert amount does not push you up into the next tax bracket.
Okay, so while none of us like to see the value of our portfolios decrease, this is one financial planning strategy that takes advantage of a decline in portfolio values to help you increase the value of your tax-free retirement accounts over time. The one caveat with a Roth conversion is time. This is a strategy for a long-term oriented investor. Hopefully, this episode gave you something to think about. While this strategy may not be suitable for everyone, it should be at least a reminder that we can still be strategic about our assets even when things get ugly. In the next few episodes, we'll bring you other financial planning strategies that investors could possibly take advantage of during this market decline. In the meantime, please subscribe to the podcast and sign up for our emailing list to stay up to date. Thank you for listening, and we'll see you here next time.
The Paragon Podcast is brought to you by the professionals at Paragon Financial Partners, a registered SEC investment advisor. The topics discussed herein are for informational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The financial strategies and guidelines discussed herein may not be appropriate for everyone, as each individual circumstance is unique. Please review all tax information with your tax professional. Please review all legal information with your legal professional. If you have any questions or would like additional information, please visit our website at paragonfinancialpartners.com or email us at info@paragonfinancialpartners.com.